All right. Good morning, everybody. Today we get an opportunity to trade one of my favorite morning trades, a liquidity gap. Now this thing is called something else. I've heard it called all kinds of things. And the usual comment that I see is traders who say, I don't see a gap. There's not a gap in the candles. It's called a liquidity gap. We're thinking about orders on the dome in the queue. When price makes a move like this, and it doesn't have to just be on big events like CPI and non-farm payrolls, it can happen intraday. Once you start looking for it, you can see this all over the place in different forms and different shapes. But this is kind of the idea of what we're going to be looking for today. And I don't care if it goes up or down. We just need this sort of image. So this is a 5-minute chart. It's a single direction, one big candle, no wicks going in the other direction, no big wicks on each side. This is one that worked. I'll show you ones that didn't work. And the good thing is, if it doesn't have the setup, there's just no play. You don't have to worry about taking the trade and then finding out, oh, wait, no, never mind. Because if the first candle doesn't have the setup that we're looking for, there just is no setup. So it's perfect. This was one of those, either CPI, non-farm payrolls. It's one of the three. Big print in a single direction, built a little bit of a base. As we got into the RTH, we began working our way back. We got there at around 11 o'clock. We got to where the 8:30 candle opened. That's where you close the gap. You get back to the 8:30 open. Here's another example where we went long instead of short. 8:30, single print to the upside. It spent the rest of the morning working its way back. It got there somewhere around 11 o'clock. It needed to get to the gap close to where we opened at 8:30. Notice the time frame, right? Watch the clock is a mantra that I pound on constantly because it really has a lot of merit in what we do. Watch the clock. I'm not being sly or slick when I say that. There's no hidden meaning to it. I'm literally telling you, look at your watch, look at the computer. Economic data and market closes from around the world happen on a schedule. It's as simple and as basic as that. Liquidity will come into the market on 30-minute candles, 15-minute candles, although I don't push that one too hard, and 30-minute, 60-minute candles. So if you're trying to run a small account and you're running tight stops and you take a trade 2 minutes before 1 o'clock, and then 1 o'clock hits, volatility picks up, it stops you out and runs away without you. You didn't look at the clock. You didn't realize if you'd have just waited for 2 minutes, you could have then took your trade and rode that move, that volatility, rather than getting stopped out by it. It's also where we often see a change in market structure. But here's another one, 8:30. This was CPI because I marked it. A print in one direction. Notice it's not one candle this time, but it kept going in that single direction. There's no big wicks to the downside. It didn't try to come back down already. It just kept driving in that same direction before it topped out, and then it spent the rest of the morning trying to get back to the 8:30 open. It got there around 11 o'clock. So here's an example of what it looks like when we don't want it. So if we get a print today and it's big wicks on each side and it closes really close to where it opened, the entire thing is done. We're just, there is no gap close trade. And this doesn't mean that we can't continue to trade and you know, the day isn't done. There's still plenty that we can do. Just this trade is no longer on the table at that point. Now, all of these pictures are on the ES. In the last 2 months, we've gotten these non-farm payroll CPI events, And the ES didn't necessarily have a good gap close, but the NASDAQ did. So, just because one isn't getting that gap or doesn't even have the setup for the gap doesn't mean that the other market won't. And I tend to trade the NASDAQ more than the ES anyways, so it works good for me. Here's another example of where it didn't work. And another example of where it didn't work. So you kind of get the idea. It'll be very simple to see if today is going to be one that even offers us an opportunity or not. Because if there's big wicks on each side, there is no gap close trade. Now, there is a threat that it'll make one of these single directional push one-time framing moves, and then it doesn't close the gap. That is absolutely possible. That is not a guaranteed gap close just because we get that candle. I think the last CPI, we had the proper candle and we just never went down there and closed the gap. Okay, so it's not a guarantee. It's not a promise. Now, this is an extreme candle. It's a very large candle. So as you can imagine, you're not going to get something like that every day. But if you go looking around on just a normal everyday basis, a lot of times you'll find where there was, a reasonably decent sized candle where it either fell down or spiked up, and then it spent, the next 30 minutes or so getting back to that same location and quote, closing the gap. So you find it more now that you know about it. There's actually a psychological aspect to that, right? That once you know that something exists and you know what it looks like, you tend to see it more often. So you can find that same setup on intraday charts. It doesn't just happen in the futures. You can see it all over the place. Equities. Today is very likely going to be the most important data point that we have between now and the end of the year. Really kind of hold the weight of that for a moment. This data point is very likely going to impact us into next year. I can't think of anything else right now that has more weight to its decision model than this between now and the end of the year. There's nothing else bigger that I can think of right now. Now, sure, we've got some issues. There's a lot of bricks in the wall of worry. Government shutdown being really high on that list. So, there are other issues at play. But when it comes to economic data points, this is very likely the biggest one that we have between now and the end of the year. I was looking at spot gamma, and their note for CPI was, unless there's a big miss, this is very likely going to be the start of the Christmas rally out of late November and into December expiration. Assuming that CPI is in line, we'd anticipate the equity market on the high of the equity market being Wednesday at 11:15, with consolidation happening into and around the 17th, which is OPEX. That would clear the way for a final year-end rally. 4,500 is their current upside target in that scenario. And then, of course, they'll adjust it based on how they see call positioning as we get closer to it. So again, this is it, right? This is the one. Now, Michael Mott from Mott Capital, he had a video that he puts out on Saturday. He does it every Saturday. And I've kind of got my go-to people, right? The guy is, he's a fund manager. He's got his own Bloomberg machine. He has a Substack. He has a spot at Seeking Alpha, which is where I first ran into him. So the guy's been around for a while, right? He's my weekend go-to. I'm not subscribed to any of his services, but he puts out a free video on Saturday. And the video that he put out this Saturday talked about the way that CPI is quantified, right? Where the numbers come from and then how it's dispersed. He had a really interesting take on one of the data points, which is the healthcare part, and how they normalize that data and it gets kind of readjusted in November every year. And then that data point gets spread out over 12 months, and they just basically divide it by 12 for the next 12 months. He showed examples from 2022 and 2021. On one of those we missed, on one of those we hit, and how it directly connected with that healthcare part of the CPI, and whether that number had come in as gaining or decreasing. We have been decreasing by 4%. The numbers that he showed suggested that we were going to start gaining by 1%. Now, everybody's ready for CPI today, and the consensus number seems to be 3.3. Well, if we come in a little light and we are under that 3.3, the markets are going to love it. We're going to very likely explode higher. But looking at what Mott was talking about from Mott Capital, he seems to imply that it could come in heavy, that instead of being 3.3, it might be higher than that. 3.4, 3.5, 3.6. It was 3.7, and we're expecting 3.3. But what if it is nowhere near 3.3 and it's closer to this 3.7? The market's very likely going to sell into that. Now, he only mentioned one data point, and there's a lot of data points in the CPI, and this isn't necessarily the only number that the Fed is looking at anyways when it comes to those CPI numbers. So, you know, we don't want to run out and try to trade this before we even get the data point. But my expectation is that there's not a consensus. A consensus is where I get a little nervous and I kind of get a little excited, because when I listen to the news and I'm out checking what other people are saying, if they all think we're going to do something and they start getting cocky about it and start using phrases like we know, oh, we know it's going to come in light. No, you don't. You don't know. I don't know. You have no freaking idea. But the cockier they get, the more likely it is that they're going to get caught off sides. And if they get caught off sides, that's where we see big moves. Right now, the market is expecting to go from 3.7 to 3.3. And that's a number that has been pushed around pretty confidently over the last 7 to 10 days. It's not as elevated as I would have liked it to be on kind of the scale of what we think we know, but it's high enough. I would watch for them to be caught off sides today, so that if we do start to go down, I think we're going to go down a little bit more than we normally would. It's going to very likely be a violent scenario. So I got the spot gamma levels here. We're still above the volatility trigger. We're still above 0 gamma. We're really close to the call wall. So 44.64, that is the call wall. We expect selling when we get into that call wall, but they don't have to, right? They can roll up. They can just, you know, decide they want to monetize at a higher price and roll out. Otherwise, if they hold their ground there and they begin to monetize those calls, that's a sell zone. We're nowhere near the put wall. It's way down here somewhere. Yeah, there it is. 4,011, which happens to also be the COG line. We have a market maker move today, and the volume is really light today. because we're waiting on CPI. It makes perfect sense, right? We know that market maker move means that they're hedging in the front end. They're a little concerned and they are hedging. Okay. We're able to wrap our head around that pretty easy. We have moved away from that weekly pivot point, but we're not, way overextended from it. We have a daily missed daily pivot, but that's not going to last. We never did hit the daily pivot from yesterday. It's actually buried underneath this weekly pivot. So we did carry forward a missed daily pivot from yesterday, but I don't see how we can get away with not hitting it today. We could just shoot straight up and never touch it, but that's kind of low on the probability scale. So when we calculate range, the ADR, the things that we could do today, the average daily range right now is 1.25%. And this range is that 1.25%. From where we closed, or excuse me, from where we opened in Globex, we could go up or down. And the distance between these two is that 1.25%. Okay. I mean, we've kind of gone over that enough that it's not surprise logic. From where we open in the Globex, if we run a single direction 1.5%, then we get to the yellow line. That would be the upside move, and the one down here would be the downside move. Again, it's just the same number, 1.25%, the 21-day average daily range. But instead of cutting it in half, we're just talking about a single directional push. Beyond that, we can add the market maker move. So if we were to expand beyond the yellow line, we would want to add that 0.35, basically another $15. And that gets us to the voodoo line, 44.99, call it 4,500. And to the downside, just above the previous week's low, 43.56. I'd call that 43.50. I wouldn't even try to negotiate with it, right? 43.50 to the downside, 4,500 to the upside. That's our range today, just using the market maker move and the average daily range. He has been. Yep. The comment is that Mott is a little bit of a perma bear. He is, and Kaufman is, and I mean, you go down the list, a lot of them are, right? One thing that really stuck with me is all he was talking about this weekend is how the data comes in for that CPI and the discussion about how they're looking to change it from a 12-month to a 6-month on that healthcare CPI data print. So he wasn't really, at least the part that I was focused on, he wasn't putting his bias in there per se. He was just saying, look, these numbers get normalized every November. It's when we get the new ones. And this is the outcome from previous Novembers when the new data got brought in and normalized. Numbers lie, right? And what's the phrase? Figures lie and liars figure. We can make the numbers say whatever we want. Depending on how I present data to somebody, I can put my bias in there all I want. But we can also use numbers and get rid of the bias. We can strip it all down and just put math to work, which is what I'm doing here with the market maker move and the ADR levels. I don't have a dog in that hunt when I add market maker move to an ADR and say we could go to 4,500, or we could go to, 43.50. That's just math. So that's our move for today. That's our range from 43.50 to 4,500. And that isn't even extreme. I know it might sound extreme, but that I'm not even reaching yet. So putting the market maker move in here, this is our 1-day range. If we want to see what extreme looks like, take the number and cut it in half and add it to the top and the bottom. I'm not going to nail this perfectly, but we don't have to, right? We can just get close. Now you're looking at 42.75 and 45.75. Just use some easy numbers. And again, this is just math, right? And that is, I'm not overreaching here. I kept that a conservative estimate. Now, do I really think we're going to move this far? No, I don't think we're going to move that far, but we could move that far very easily. From where we opened up, that would put us at 3.5%. The market has a history of moving more than 3.5%. So, we got lock limits at like 7 something, and we've hit those before. So a 3.5% move, I'm not reaching. What would make it a little fantastic is that normally if we were to make a 3.5% move, we start making that move when we open in the Globex, that we spend, most of the 23-hour session working in that direction. So far, we've spent most of our trading session doing nothing. We haven't gone anywhere. We haven't done anything. So if we were to make a 3.5% move at this point, we would be doing it from basically a starting point of nothing, because we're at 0.2, 0.1% this morning. We haven't done anything, not even at a tenth. We're flat. $8:30, 11 o'clock, and that's it. Now, if we come in and we look at some of the other things that we got that we could see today, we've got some Fed speakers here in the US. We got Bank of England speakers, European Central Bank speakers. And we got a lot on the table, right? There's certainly a lot going on. Plus, Johnson is out there in Washington trying to get the house in order, right? So that we don't shut down Saturday. That news by itself could move this market. Any news where they come out and say it's not going to happen, or on the other side of it, that he's got enough votes to make it happen, that could pop us up or down. So it's not about technical analysis at this point, right? It's not head and shoulders and wedges. And right now it's just data points. And those data points are going to be in control. We saw some moves yesterday in US dollar Japan that suggested some form of intervention. Now, remember, they will straight up lie and say, we didn't intervene. No, wait, that wasn't us. I looked around, I didn't see anything, but I didn't have a lot of time to look. So if it was intervention, it was a piss poor job of it. And I don't know that it was. Looking at how the intervention was back in October of last year, and then looking at what we saw yesterday, I'd say it wasn't. But it could have been a minor intervention, right? It doesn't have to be the big guns. There's a lot of tools at their disposal. Who knows what they did, right? And I'm hoping to find some articles that'll give me a little bit of insight. I was just really busy and I haven't had a chance to crawl through anything yet. When I looked yesterday, it was pretty close to when the event had happened. And so nothing had been out at that point. I'm hoping between then and now, maybe some more articles have come out. But we didn't really see anything out of that, right? At the most, we could say we started to sort of stabilize, but we had already done that anyways, right? And so kind of that move up from there happened after, but I don't think it was a cause and effect, right? That there's just not enough data to point to that. Either way, that's a fantastic move in US dollar Japan. So at this point, you know, going through the rest of the steps, focusing on things that are up this morning, things that are down, what could go long, what could go short. It's just a futile effort. It's all going to come down to the data points this morning, and nothing else matters. Keep in mind that air pocket of risk below 43.50. There's really nothing to help us out. So this, kind of helps support the idea that a move down is very likely going to be a big sweeping move, because there's really not a lot down here to help us. And there's nothing to the upside that would interfere with us. We did hit that VPOC yesterday, and we ran right through it like it wasn't even there. So we're done with that one. We can take it off the table. We don't need to carry forward one from yesterday because we've been cutting through that zone all night. You can see this is what they call a very narrow IB. IB is the initial balance. The old school initial balance was between 6 and 7. I've seen a newer modern version that starts at 9:30 to 10:30. Whatever, right? To each your own. I've got an opening candle that I use at the RTH. So to me, initial balance is between 6 and 7 at night. A very narrow IB implies that there is still a lot of work that needs to be done and that they could come in and trade that work at any point. If it had been a really big, wide IB, then we would say, the work has already been done and that they don't have a reason to come in and trade at that point through the rest of the day. Now we started to get some movement through the kill zone. The kill zone is between 2 and 4. I didn't give it that name. That's just the name it was given. Statistically, that's where the biggest moves in the market happen within a 2-hour period of time. Bigger moves than the open, bigger moves than power hour, bigger moves than the close. Statistically, that 2-hour window between 2 and 4 a.m., that's where you see the biggest moves in the market, statistically. Not a surprise. We've seen a little bit of movement there last night. But after that, we went right back to the zone that we had been working on. And we're just waiting on CPI. A hurry up and wait scenario. Remember those levels we gave, 4,500, that's outside the weekly expected move. It puts us back here around September's candles. We're through the halfback, by the way. Now there's some concern about these wicks. And yes, we are, looking at an inverse head and shoulders here, but it's a daily head and shoulders. It could take weeks for that thing to play out. And, there's like a running joke that if your entire trade is based on nothing more than a head and shoulders, then you basically had nothing to begin with and you're reaching, right? That you definitely always want something more for the reason or the basis of your trade than a head and shoulders. It's like the last straw of a desperate trade, right? You couldn't find anything else, but you were able to point to a head and shoulders. They just have an abysmal track record on the higher time frames, and they take so long to play out that they just don't have any weight, no value to them. But what does have value to me looking at this chart is this structure here. So into that 44.30, the cog line, these previous wicks showing that sellers were there, the wicks from the last 2 days, and even from today, showing that there's still a lot of trouble getting through that zone. And so far, we haven't been able to do it. Even if we get through it this morning with an upside shot due to CPI, we're looking for a gap close because of that shot to the upside. And we would be expecting it to come right back down to close that CPI gap first. It can stay bullish after that, or it could be bearish and come back to that gap and stay bearish after that. Either way, there's still a lot of data showing that this is a significant level that we're going to have a hard time getting through. Doesn't mean we can't get through it, but we've got a lot of data suggesting it's going to be hard to get through. Everybody, be careful, be safe, have a good day. I'll see y'all tomorrow.